Hey, hey, welcome to the webinar. I'm so happy that you guys are here with me this evening. I see we got a lot of people registered. That's exciting. So today what we're going to go over. So first off, let me say that every single Monday, okay, we'll have some type of financial training using this same exact link, which is financialtraining.amathecpa.com. So today we're going over credit and how credit keeps you broke. After the webinar, there will be a link that will go out to everybody that registers. So that'll be good. So you guys can kind of go over it, review it. And then of course, I'm always here if you guys have any questions. So right after the webinar, right after I go through everything and kind of explain everything, you guys, I'm here. You know, you can ask me any questions and I won't be able to hear you, but what you can do is type it in the chat room. Just type it in the chat room and then I can answer any questions right there. And then, you know, and it can be any financial questions, okay? It can be related to this webinar. Like I said, we're going to go over credit, but it can also be related to taxes, which is taxes is really my specialty. I am a certified public accountant and, but we can go over taxes or W-4 adjustments or, you know, whatever questions that you would have for a certified public accountant, I am here, okay? So we'll go ahead and get started. And what I'm going to do is share my screen so that you guys can see. Let me make sure. Let me make sure this is what's exactly showing on this screen before I get this started. I know I'm so silly. Y'all, please forgive me. Please forgive me. I just be cracking up to myself like literally all day. Okay, so we'll go ahead and get started and welcome. I see people steadily joining the webinar. Welcome. I hope everybody can hear me okay. Let me make sure that my volume, it looks like everything is good. So we'll go ahead and get started with this webinar. So give me 1 second and I'm going to share my screen and then walk you guys through. Have a message coming in. I hope it's not for me. Okay, never mind. Sometimes I'll get a message like we can't hear you or we can't see you or, you know, something like that. So that was neither. So we'll go ahead and get started. I don't have any complaints or anything from anybody. I just want to make sure, can everybody hear me okay? Can somebody write in the chat room real quick before we get started if you can hear me and see me okay? And then we can go ahead and get started. I just want to make sure. So I'll go ahead and share my screen while you guys are doing that. Okay, great. So it looks like everybody can hear and see me okay. So we'll go ahead and get started. So credit is really one of those things that is so important, and it's crazy because a lot of people really don't realize how much credit affects us. Okay, they don't realize how much credit really affects us. So I'm gonna go ahead, let me share my screen. Share. Don't know. Okay, here we go. Okay, so you guys should be able to see How Credit Keeps You Broke by Ama A. Nancy, Ama the CPA. I think that Looks kind of funny. All right, so last time, so we'll go ahead and get started. Here we go with the slides. Okay, so how does credit keep you broke? By me, Alma the CPA. So thanks again so much for tuning in. I'm so happy to be here with everybody and just happy to be able to share this information. So a little bit about me. My name is I go by Alma the CPA because I am a certified public accountant, right? So that's what CPA stands for, Certified Public Accountant. It is a very difficult exam. It's actually the highest level that you can achieve in the field of accountancy, okay? But outside of that, it's not to say that I know everything when it comes to finances, right? So what I did for myself is I just got around some mentors. I have some amazing mentors, one of which is worth $600 million. One mentor is worth about $300 million. One mentor was a millionaire by the age of 25, and I have another mentor, a millionaire by the age of 26. I have a mentor that never worked a job a day in his life. So literally, I have some amazing mentors that I'm surrounded by on a very frequent basis, that I can reach out to them. They're here for me, and they have taught me these different financial principles, because even though I am a certified public accountant, some of this stuff was taught in school, but personal financial education was not taught in school. Okay, even in my, 18 years of education, something like that. I don't know exactly, but after you figure out, college, up through high school was 12. Okay, so it has to be like 18, 19 years of education. They do not teach personal financial education. So I learned a lot of information from my mentors that have taught me so much. And I just really feel, especially being a certified public accountant, that I should be here to teach the public when it comes to some of these things as well. Okay. So like I said, I want to go over credit. So what exactly is credit? Now, credit is really the contractual agreement in which you will get your value now, right? You get whatever it is that you want right now. You get it immediately, but at the same time, you agree to pay back at some date in the future. And most of the times that includes with interest. Now, sometimes people will have you on different type of payment agreements. Maybe you have to pay the whole thing in full. Maybe you can make installment payments. Maybe if you pay it within a year, you do not have any interest. But rest assured, it's some type of agreement, and that's exactly what credit is. And before I forget, I will go through a worksheet at the end of this webinar. So if you didn't get a chance to download that worksheet, it's on the link when you register for the training, which is financialtraining.almathecpa.com. Or at the same time, you can feel free to write along with me as I go through the worksheet towards the end of the webinar. So that's what credit is, right? So it's so many different types of credit. The most I would say, well-known type of credit is really installment loans. Okay, so installment is when you agree to pay it back in installments. You agree to make monthly payments or weekly payments. So this is like your car loan, your student loans, any furniture purchases. A lot of furniture companies will have where you can finance something and pay back on a monthly basis. Of course, mortgage loans, but then we also have credit cards. And credit cards generally come from banks, or you may have one from different retail establishments. When I was in college, I had one from Express because that was like my favorite store at the time. Okay, but you can also get one like Target has one, Macy's has one. I'm here in Chicago. We have Carson Perry Scott. You know, they have one. So all types of retail establishments. And believe it or not, gas stations have credit cards as well. So some people have all these different types of credit cards. I just didn't want to leave anybody out, but these are the different types of credit. I wanted to be very clear because I don't want people to see this and say like, oh, well, I don't have this type, so it doesn't apply to me. All of these are credit, okay? And then also any loans that are taken on by any type of collection agency. So what happens with this type of stuff is, let's say you owe Macy's, right? Now, if you owe Macy's for a certain amount of time, well, let me backtrack. Every year, when retail companies or when companies record their financial information, their books, so to speak, right, they have to include an allowance for uncollectible debts. So what that means is that if I'm a company and I say that a variety of different people owe me $50,000, a certified public accountant like myself will come in and say, okay, yes, people owe you $50,000 and you can put that on your balance sheet as an asset. But we won't allow you to claim the entire 50 because the likelihood that people will not pay is very high. So we can allow you to include only $40,000, right? So what that means is that you can only report $40,000 on your financial statements. So a lot of times once a company reaches that level, so let's say it's the end of the year and we actually collected $45,000. So yeah, we did better than we expected. Now we have that $5,000 still out there. They can choose to either leave it out there and still reach out to you and ask you to pay it, et cetera, et cetera. Or after a while, and it's different by, it varies on different companies, after a certain period of time, they will sell that to a collection agency. So that $5,000, they may say, okay, we can sell it to XYZ collection agency for $2,000. Now, this collection agency will buy it for $2,000 because they are hoping to recoup the whole $5,000. I hope that's making sense. So unpaid loans taken on by credit collection agencies or debt buyers can also go onto your credit. Okay. So all this stuff goes on your credit report. Now, your credit report is really your buying power. This is what makes you more, this is what allows people to even loan you money in the first place is your credit report. A lot of people are familiar with this because your credit report leads to a credit score, which is a whole nother story. And I don't want to make this training too long. But your credit report is a collection of information that's related to your credit history. So, of course, it includes loans that you've had in the past, even if some of this stuff is paid off. And this is very important because a lot of times people feel like, oh, it's old or whatever like that. But I want you guys to think about a credit report just like a report card. Okay, think about your credit report like a report card that has your cumulative GPA on there. So yes, when you first start out, you may not have anything. And your first few classes, maybe you get all A's, you get a 4.0, right? That's just like your credit report. So maybe your first few credit cards, they were small, you paid them right off immediately. So you have a very high credit score. Then you turn around, you maybe start doing not so good in some of your classes, or with the credit report, you're doing not so good with paying things off in a timely manner. And then that affects your credit score. So it also includes the loans that you've had in the past, as well as the current loans that you have. You know, your monthly minimum payments, how much you borrowed, all of this stuff is included in your credit report, and mainly your history. It also includes bankruptcies or any foreclosures. So any loan that you have ever had that you have defaulted on or that's in collections will also go on your credit report. A lot of times people may not realize this, but even like I know here in Chicago, they actually just pulled it away, but utilities were able to report on your credit as well. So now here, what they do is they just hold a deposit now to, so they won't report it on your credit. But a lot of states will still report that on your credit as well, even though it wasn't a loan that they gave you, right? But you just didn't pay your bill. So now they're going to classify that as a loan that you defaulted on. Maybe they consider it like, you know, they loaned you electricity. I don't know. But that can also go on your credit report, as well as like unpaid cable bills or cable boxes. If you don't return them, things like that, they can include on your credit report. So now that was just a little background history, just so you guys can kind of understand where we're kind of coming from with all this stuff. So now you may be asking, well, how can this mess you up? So here's the thing. Your lack of money will always, always cost you money. And it sounds kind of crazy, but that's just the truth. So people that are less fortunate, people that don't have a lot of money, I don't necessarily want to say broke people, but just middle-class people, people that don't have a lot of money, disposable money or discretionary cash, I should say, will always, always pay more money, right? So your lack of money will always cost you money. If you guys are taking notes, please definitely put that one down. So let me just explain. Let's say I want to buy a car, right? And I have $10,000 saved up, and I'm so proud of myself because I saved up $10,000. So I go to the car lot and I'm like, okay, I want to get a car. I can put $10,000 down. They say, okay, so the entire car is worth $40,000. So we will finance you $30,000, right, at 15% interest. Okay, so I'm feeling good because I put my $10,000 down and I didn't have to finance the entire car. However, let's say you, on the other hand, you go to that same car dealership and you're like, well, I know that the car you guys are asking for $40,000. However, I saved up $31,000 in cash. Right? Are they going to take that $31,000 from you? Or are they going to say, no, we only want to sell the car that we can finance? No, they're going to take that $31,000 from you. So you can pay that $31,000, walk away with the car, even if they charge you, even if you have to finance the difference, right? But they'll definitely give you a deal. But let's say you have to finance the difference. Your interest that you pay over a period of time is going to be much, much less than the interest that I pay because I had to finance the entire thing. So my lack of money costs me more money, which is crazy because that's part of how the cycle starts, right? Because I don't have enough money, so now I have to finance it, and now it's costing me more money in the long run that I have to pay. Okay, so just write that down. Your lack of money will cost you money. So the other way that this messes us up is debt is our second largest expense. So we talked about in our webinar last week, if you guys were here, we spoke about taxes and how we save money on taxes, right? So how we save money, not how we save money, how majority of our money goes to taxes. So if 1/3 of our income goes towards taxes, I want you guys to think about the other 1/3 of our income going towards debt, because I just kind of mentioned how we have to finance so much stuff. So if we have to finance everything, think about it like this. If 1/3 of our income is going towards taxes, and then now we have to finance or incur debt to make up the difference for our income, because our income is, so I don't want to get too ahead, but so think about it. Our income is the total amount of money that we bring home, right? Or the total amount of money that we actually make. Now, 1/3 of the income goes towards taxes, so we actually never ever see it. Then what happens is we try to make up the difference by financing the rest. So let me explain. So it's like, now you probably maybe don't understand. So it's like, why is debt our second largest expense? Because our loans are based on our gross income. So think about it like this. When you go to a bank, or when you go to a furniture store, or wherever it is that you're taking out a loan, they ask you, how much money do you make? They never ask you, how much money do you bring home? So what happens is, let's say you make $50,000, but after taxes, you only bring home $32,000. So, but when you went to get your car, when you went to get your mortgage, or your apartment, when you went to get your furniture, anything that you have financed, even your credit cards, they ask you, how much do you make? So they financed you on the fact that you earned $50,000, even though in reality, you only bring home $32,000 after taxes. So you're probably asking, like, why would they do that? And that's because they can charge you more interest, right? So if they give you more money because you make $50,000, so now you can, quote unquote, pay back X amount of dollars because you make $50,000, which is like a, considered a good salary. So they finance you on, a $50,000 car, $150,000 home. You can finance your furniture because they're saying, oh, okay, well, she makes all this money, she can afford it. But the reality is $18,000 is going off to taxes off top. So they finance you, they give you loans based on your gross income because it allows the creditors and the companies to make more money. And that's how they make money. Okay. Because of the interest. So now this leads us to compounding interest. Now, this is another thing that I would like you guys to write down. Compounding interest is interest that is calculated on your initial principal balance. So if you borrow $50,000, is interest on that $50,000. If you borrow $5,000, is interest on that $5,000. Now, most people understand that, but where people kind of don't understand it as much is it also includes, and that's why we have and in all caps, it also includes the accumulated interest of the previous balance. So basically what that means is that it's interest on top of interest. And this is how credit keeps us broke, because you are not only paying, if you borrow $5,000, you are not only paying $5,000 plus the interest. So if you're paying, and I'll go through the example, but you're paying every single month, it's accumulating interest. So now 1 month, let's say you miss a payment, your bill is $5,100. Now that next month, interest is calculated on $5,100. It's not only accumulated on the $5,000. So compounding interest is really how credit keeps us broke, because it's interest on top of interest. Please write that down. Please write that down. So now what I want to do is get into this worksheet. If you guys got a chance to download the Bloody Mess worksheet is what we call it. So the first thing that I want to go over, and if you didn't get a chance to download the worksheet, you can still write along or just listen to what I'm saying. So this is a quote from one of my mentors that I just love, love, love. This quote is so true. Interest is the price you pay to get something in advance that you cannot afford. And that's Mr. Ivy Stokes. That's the $600 million man, one of my personal mentors, my coach, my friend. And that's a quote from him. And think about that for a second, ladies and gentlemen that are on the line. If you think about that, that's really exactly what it is. If you have cash to pay for something, then you'll just pay it. You won't incur any interest at all. So interest is the price that you pay just to get something in advance that you really can't afford at that time. Not saying that you can never afford it, but you can't afford it at that time. So let's say you owe $5,000 to a credit card. The monthly minimum payment, and if you guys downloaded the worksheet, then please just fill in the blanks. Okay, the monthly minimum payment is $100. Now, we'll be nice and say the interest rate is 21%. Okay, we'll be nice. Even though some interest rates are a lot higher than that. Now, before we go on to step number 4, let me just say this is where a lot of people get the fact of compounding interest mixed up, and how interest works, period. So they may be saying, some people may say, okay, so at $5,000, I'm borrowing $5,000, my interest rate is 21%. So $5,000 multiplied by 21% is $6,050. So that's only $1,050 in interest. So a lot of people say like, okay, what's the big deal? I don't have $5,000 right now today. So I just end up paying $6,050 later in the future. Ladies and gentlemen, that is not the case. Okay, so now we're going to go through and I'm going to show you guys how you can figure out the monthly interest rate on your credit card and how you can figure out how much you are actually paying. So the credit card, your rate is 21%. So what you want to do first is figure out how much you are paying in interest per month. What is your monthly interest rate? So to figure that out, you take the 21%, which is your annual rate. A lot of times it's just known as APR on your credit. It just says the APR on your credit statement. So your annual interest rate is 21%. So you want to divide that by 12 months. That gets us to 1.75% per month, okay? 1.75% per month. Now, number 5. So how much is that in interest? What is your interest payment? So remember in school when we had to carry over the decimal to make it, you carry it over 2 times, right? So boom, boom, that gives us 0.0175. It was a percent, but we converted it. So it's 0.0175 multiplied by your $5,000, which is your original outstanding balance, your original loan amount, which gets you to $87.50 per month. Now, let me explain what that is. That means that out of your $100 that you're paying every single month, $87.50 of that $100 is going towards interest, which means that that's how much the bank is making every single month, because the interest is what you're paying them for giving you something in advance that you could not afford at that time. Okay? So you're paying them $87.50 per month, which is basically, it's all going to interest, which means that it's doing nothing for you. It's doing nothing for your principal payment. So if $87.50 is going towards your interest, then how much is going towards your principal? So number 6, your principal payment is $12.50 per month. So we figured that out. You can basically just do the $100 minus $87.50. Okay, so $100 that you're paying every single month minus the $87.50, then your principal payment is $12.50. So that's the amount that's going towards your principal every single month, right? Now, remember what we said about compounding interest. Compounding interest is interest on top of interest, which means that every single month, not only are you paying interest on your principal balance, you're also paying interest on top of the interest that is earned. So in our example here, with this $5,000, if you make a payment for 1 month and you say, okay, some people may be thinking, okay, my outstanding balance is $5,000. I sent them $100. All I owe is $4,900. So what I'm telling you guys right here is that that's not the case. After 1 month, you send them after your outstanding balance is $5,000. After 1 month, only $12.50 went to that principal payment, which means that you owe them $4,987.50 per month. Okay. I mean, I'm sorry, as your outstanding balance is the $4,987 as opposed to the $4,900 that a lot of people get mixed up. So what's your reality? Because only $12.50 is going towards the principal payment. So what that means is that your reality is, let's say, so we take the $5,000 because we're trying to figure out how much that is. $5,000 divided by $12.50 because that's what you're sending them, the $100 per month. So $12.50 is going towards your going towards your principal payment, which means that is 400 months that you will be paying this off, this $5,000. So your sentencing, which is basically how long is 400 months? How long do you have to pay off this one $5,000 debt? Not even to mention that a lot of people in a lot of households owe much, much more than $5,000, okay? So your sentencing is you take 400 months divided by 12 months. That's 33 years, ladies and gentlemen. That is 33 years that it will take you to pay off this $5,000 loan, whether it be credit cards, a loan, or whatever, at 21% interest is 33 years, which means that your bank, because you paid them, I'm sorry, this should be $100. This is the typo right here. If you take $100 per month, I just shouldn't have the S on there. You take $100 per month, multiplied by the 400 months. That's $40,000. That's $40,000 that you paid your bank. So essentially they loaned you $5,000 and you pay them back $40,000. This is why, ladies and gentlemen, credit keeps us broke. And I'm not laughing at anybody's situation. I'm just laughing at the awareness, right? Because that's what it's all about. Once we know better, we can do better. And I just want you guys to realize, hopefully this is helping somebody just learn something, get some new information, and just this new awareness that This is why credit makes us broke. This is why most Americans are in debt, and most Americans are living paycheck to paycheck. Most Americans feel like they are on a hamster wheel because they cannot get out of this bloody mess, right? And this is just saying, for example, $5,000. Now you can take this same exact example, apply this to your student loans, apply this to your car note. Some families have multiple car notes. Apply this to your mortgage. Okay, apply this to all your credit cards that you have. And then also, any furniture credit cards. You want to apply this same premise to any outstanding loan that you have. Any outstanding loan that you have, to figure out how long it is actually going to pay you. It'll actually take you to pay all this stuff off. So I can go ahead and conclude the webinar here if anybody has any questions. But I also do want to say, like I mentioned, a lot of this stuff was taught to me. We do have an amazing program where you can learn different things like this. We also have a program that can help you get out of your debt, eliminate some of this debt very, very quickly. We have people in our program that eliminate debt years, some even decades, literally decades before they were anticipated, just by following some of the systems that we teach and the strategies. So I do encourage everybody, if I put you on the webinar, if you saw it posted on social media, then definitely feel free to reach out. You can also go to immathecpa.com and request a free 30-minute financial consultation. We can kind of sit down and go over everything, or we can also do it over the phone. That's cool too. And if somebody puts you on the webinar, then definitely get back with the person that put you on this webinar. They can get you in touch with somebody to answer all your questions and things like that, and tell you about the different services that we have to offer with this program. And like I said, it's everything that my mentors are teaching me, and I'm just so grateful. I've helped so many people get out of debt, including my mom, right? Including my mom, all my family members, just by following this system. But I just wanted to go through that to kind of explain to everybody why and how credit keeps us broke. A lot of times people don't realize exact causing, because they think, like I said in the example, that they're only borrowing, or the interest is only $1,050. Okay. But like we just went through in the Bloody Mess worksheet, you saw that the interest is actually about $35,000. So I'll go ahead and get out of here. If anybody has any questions, you can go ahead and, okay, I see a question. Questions can be for anything, W-4 or anything. So I see a question from Mike B. Okay, yeah, what's your question with filling out your W-4? I can answer that question. This is definitely Q&A with the CPA. So any questions that people have, I can help you with that. Do you have a specific question regarding your W-4, Mike? Questions, and Mike in the chat room for anybody that has a question as well. You can put it in the chat room. You don't have to request. I see a couple of requests to speak. You can just go up to the chat room and type it in. And then I can hopefully answer any questions that you have relating to any financial questions that you have. I am a certified public accountant, very proud of that. But I love, love, love giving back and providing service and just helping everybody learn different things. Like I said, financial education was never taught to us in school. They taught us so many things, but they didn't teach us how to get out of debt or stay out of debt, never get into debt. You know, they never taught us. Okay, so I didn't redo it this year, and I am doing it mid-year to have more allowances. How will this affect my 1040? So when you adjust your W-4, Mike's question is basically, and please correct me if I'm wrong, but Mike's question is if you adjust your W-4 during the middle of the year, how will that affect your final year-end taxes? And the answer is it won't. W-4, you basically want to put on there what you will anticipate to file during the tax year. Okay, so if you turn in your W-4 now and you do whatever adjustments to it, when you file taxes, those adjustments to your taxes will be reflected throughout the year. So it won't make any difference as far as you owing or not owing or getting a refund, not getting a refund, because it'll be reflected in what you file. Well, basically, you want to do your W-4 to reflect what you will file on your tax return. Okay, I hope that helps. I hope that helps, Mike. Let me know if it does. Okay, good. So, any more questions that I was about to say *6 will unmute your line. You can okay, holding out on the info. Sorry about that. I didn't realize anybody was holding out. So yeah, so that'll just about do it. I'm glad that was helpful. Any more questions that we have, you can go ahead and type them in the chat room. If not, okay, Miss Renee has a question. Is get your collection accounts removed from your credit report? Basically, I had student loans that were bought by multiple collectors, and they are all on my credit report. Oh, absolutely. You can get those off. So if you are a part of with Repair Your Own Credit, you can definitely do that through my Econ. I'm part of my Econ, which is a personal financial success company that I absolutely love. So you can definitely go through the steps that can teach you how to fix your own credit and get those off, because you can definitely get off duplicates. Okay. Also, if you have, which I'm also affiliated with as part of my company as well, right, then somebody can do it for you. So it just depends on if you have time to do it yourself using the Smart Money Kit that's included in our My Econ membership, or if you want to go through Nove Money and have somebody do it on your behalf. But either way, absolutely, you can get those off, Miss Renee, because that is illegal. And there, believe it or not, a lot of people do have multiple things on their credit just from situations like that. They sell it multiple times and they never take it off. So absolutely, you can get that off. Do we have any more questions? Any more questions this evening that I can help you guys out with? Before we get out of here, and if anybody has any more questions, you can be typing that in. Any questions that come after the webinar, so let's say you're watching the replay, you can still send me a question. You can respond to the registered for the webinar, and that comes directly to me, okay? And then I can respond via email. You can also reach out to me on social media. On Instagram, I'm Alma the CPA, and on Facebook, I'm Alma Nantwi. It's Nantwi, T like Tom, Nantwi, and Also, like I said, go to imofthecpa.com. You can reach out to me on there as well. My contact information is there, or you can request a free 30-minute consultation. Now, we are already in business together. Don't request a consultation. Okay, yes, Mike, you have one more question. I will be happy to take it. Okay, Miss Renee, definitely reach out to me. Okay, I have a registered LLC. Do the same rules apply for allowances? This is my first business, by the way. Congratulations on opening up your first business. Congratulations. That's super, super exciting. So no, Michael, the same allowances do not apply. So when it comes to your LLC, it's actually a corporation. It stands for legal limited liability corporation, right? So since it's a corporation, your corporation does not have allowances. Allowances are only related to your personal income taxes. Okay, so you don't have any allowances that you have to worry about when it comes to your LLC. And congratulations again, and I hope that that was helpful. Was it helpful? Let me know. And if we have any more questions, feel free to go ahead and type that in the chat room, and I can take care of them. Hope everybody is having an amazing, amazing day. Like I said, the replay will go out to everybody. You can kind of rewatch it. And depending on the quality of it, I'll go ahead and post this on YouTube. It'll also be posted on my Facebook page, my Facebook fan page. Please go like my page. I'm at the CPA on Facebook as well. Go like my fan page. And then I'll have it posted, okay, if the quality of the video comes out good. Oh, good. Okay, I'm glad that that's helpful, Mike B. Good, good, good. You are very welcome. And thank you, Miss Renee. I'm glad it was helpful. So it doesn't seem like we have any more questions, so we'll go ahead and get out of here. Everybody have an amazing, amazing evening. Feel free to reach out to me. I'm the CPA on social media sites, and I'll talk to you guys soon. Good night. Oh, your favorite CPA's favorite CPA. I'm the CPA. Have a great day.